Now let's face it, most of us are stuck in a cycle. Working a 9 to 5 job, spending what we earn and save whatever that's left over. But the harsh reality is, working a 9 to 5 alone isn't gonna give you financial freedom. Why? Because saving money is only part of the equation. Earning more doesn't necessarily mean saving more. It often just means spending more. It's called lifestyle inflation, and it catches up with all of us. And there's a cap to how much we can earn through a job. Now think about it. Imagine if you're earning $5,000 a month and you manage to save $1,000 every month. That's pretty good. But even if you increase the saving by 10% every single year, it will still take you 25 years to save up to $1 million. And that's without factoring life's unexpected expenses or the silent thief known as inflation. Now, inflation erodes the value of your saving over time because our beloved governments print more money every year, weakening the currency and reducing our purchasing power. And if you're just parking your money in a bank account, you're basically losing value every single year. So what's the solution? If you want financial freedom or even just to stay ahead, you have two practical options. One, starting a business or learning how to invest. Now, while starting a business can be rewarding, it's not for everyone. It's risky, stressful, and demands a significant amount of time and energy. And that leaves investing as the most practical way for most people to grow their wealth. But it's not something that you can approach casually. If you want to achieve life-changing wealth through investing, you need to commit, learn the strategies, and make it a regular part of your life. So in this video, I will try to explain what is investing as simple as it can be. So let's go. Hey, what's up wonderful people? My name is Jean Lu, and if this is your first time, welcome to my channel where we make a difference in life. Now before we go any further, let's be clear. I'm not a financial advisor, nor am I claiming to have all the answers. Now I've been investing for almost a decade now, and my knowledge comes from trial and errors and sometimes painful lessons. I made mistakes, lost significant amount of money, and I've also learned invaluable lessons along the way. So treat this as a stepping stone for you to get started, and always do your own research. Only invest in what you understand and truly believe in, and never invest more than you can afford to lose. Now do not use any leverage or margin unless you are highly experienced and fully understand the risks. So for now, we'll focus on building the right mindset and approach to investing. Now I won't delve into too much details like analyzing charts, reading balance sheets, and etc. I will talk more about those in future videos. Now we need to know, why do we want to invest? The motivation to invest goes beyond simply wanting to be rich. If rich is your only driver, then you will be driven by greed and the market will humble you quickly. Instead, think of meaningful and realistic goals. Investing can help you beat inflation, ensuring that your money retains its value over time. And the best thing, it can provide you with financial freedom, which is something that we are all searching for. Well, not necessarily a life of yacht and mansion, but the ability to live on your own terms. The freedom to do what you love and spend more time with the people that matters most. And finally, investing can help you build a legacy, leaving something meaningful for your future generations. So starting to invest early is crucial. Time is your greatest ally because the power of compounding, where your returns generate even more returns, and over time, this snowball effect can significantly multiply your wealth. And as the saying goes, build your wealth through a paycheck and multiply your wealth through investing. Now before we talk about investing, we need to change our mindset and relationship with money. And here's a sobering thought. Every dollar sitting in your bank account is losing value each year due to inflation. Historically, inflation averages around 3 to 4% annually, and over a decade, $100,000 of your money in savings might shrink to equivalent of $70,000 in purchasing power. That's 30% decrease just with your money sitting in a bank. Now, wealthy individuals don't hoard cash. They invest in assets like real estate, stock, commodities, which grow in values over time. They often use the asset as leverage to borrow money, reinvest, and generate even greater returns. Now, I'm not asking you to leverage like the wealthy does, but we need to understand their mindset. In essence, the rich makes their money work for them. So if you want to build wealth, you need to adopt this mindset. Use a job to build capital, and then let investing grow that capital. Now, what is investing? Investing basically is letting your money work for you. You're buying assets and hoping the value of that assets go higher in the future. Now, for example, if you bought one Google stock at $10 and if it goes up to $50 in 2 years, you have made $40 on your $10 investment. And that's a 250% return annually on your investment. Simple. Now, another example would be compounding interest. So let's say you went the safer route and you put $50,000 into a high yield saving account and you're getting 5% interest per annum. And after compounding for 20 years, your $50,000 capital will accumulate to around $132,000 give or take, and basically doubling your capital in 20 years. So what should we invest in? Now, the investment world offers numerous investment vehicles and sectors, from stocks to bonds to real estate to cryptocurrency, commodities, and etc. Each of it comes with its own risks and reward. Now, personally, I focus on stocks, particularly in the US stock market and cryptocurrency like Bitcoin and Ethereum. Now, whatever you choose, make sure you understand it thoroughly and believe in its future potential and commit for the long term. Because investing isn't a get-rich-quick scheme. It's a marathon, not a sprint. We must also consider the risk and reward trade-offs. Higher risk investment generally offer the potential for higher returns, while lower risk investment typically yield lower returns. So your risk tolerance plays a crucial role in your investment decisions. Younger investors with stable income may be more comfortable with high-risk investment as they have time to recover from potential losses. And as you age, it's generally advised to gradually shift towards lower-risk investments. This is why starting to invest as early as possible is highly beneficial. Now, cryptocurrency like Bitcoin exemplifies high-risk, high-return investment. Since 2010, Bitcoin has experienced a staggering increase of over 100,000% in value. Now, imagine investing $100 in Bitcoin at $1 per coin in 2010, and if you have the balls to hold it until today, your $100 investment would be worth millions of dollars. However, this incredible growth comes with significant volatility. Bitcoin has witnessed massive drawdown of 80 to 90% at times, which can be emotionally challenging for many investors. But in contrast, bonds are considered lower risk investments, typically offering annual returns of around 2 to 5%. While the potential for significant gains is lower, they also pose a lower risk of substantial losses. Now, my approach involved diversifying my portfolio across high, medium, and low risk investments. The specific allocation to each category depending on my age, financial situation, and risk tolerance. But I don't shy away from high-risk investments, as they offer the potential for life-changing return of 5, 10, or maybe even 20x. However, I do carefully manage my risk exposure and ensure my overall portfolio aligns with my long-term financial goals. Now, we need to talk about the psychology of investing. This is the most important point in investing and even trading, which is the fear and greed. Now, investing is not only skills, but the big part is psychology. And it takes years of experience to fine-tune your psychology and emotions. You see, the market is mostly driven by human emotions. Fear of bad news drive the prices down, as negative emotion cause people to sell early. The same is for the opposites. Greed or good news drive prices up. And as I said, the market will humble you down very quickly, especially when you get too cocky and greedy. The market usually rewards those who are patient and have done their homework. Now, you always hear about people losing a lot of money in investing and getting into big debts or never investing again due to some bad experience. Sure, we definitely can lose a lot of money investing, but we have to understand why that's the case. Why people lose money. Now, the most important thing we need to understand is market cycles. Markets moves in cycles. Prices go up and down over a period of time. When prices goes too high, they will retrace back down, and the same when the prices go down, they will have a chance to bounce back up. So let's look at this important chart, the famous Wall Street cheat sheet. This chart shows the typical market cycle and the psychology behind it. During a recession or when the market has dropped to a lowest point, most retail investors, aka the herd or aka the ordinary people, have already sold out and lost a ton of money. This is where the smart money, the institution, the elites, etc. will start buying and accumulating at the lows, which slowly drive the prices up over time. And when the prices start to go up, it will start to attract more attention. The dumb money, the retail investors, and those who have sold out will start to feel FOMO, fear of missing out. And when the prices gets even higher, it will start to attract more and more people, and you will start to hear from your friends, your relatives, the people who usually don't invest or don't even talk about investing, start talking about investing. And this is when the majority of the people will get in, when the prices are extremely high, and this is when the smart money, the people who bought at the bottom, they will start to sell and take profits. And when the selling starts, this will drive down the prices, inflicting fear and panic on those people who have bought at the top to sell while the prices are going down, and eventually selling everything at the bottom, losing a ton of money, and worse, some use leverage and margins will lose even more and go into a massive debt. The market will continue to drop heavily due to leverage being wiped out, and when everyone has already sold out, that's when the market will finally hit the bottom and the whole cycle starts over and over again. This happens every single time. And that, ladies and gentlemen, is how the majority of the people lose their money. So if we understand it or even experience these cycles before, we need to force ourselves to do the exact opposite. Buy when the prices are low and sell when the prices are high. I know it's cliche. It's easier said than done, but it is that simple. It's simple, yet it's the hardest thing to do at the same time. Buying when the prices crashes to a new low is scary, and selling when the prices are high is hard because you think it's gonna go higher. But we have to remember that the majority of humans have a herd mentality. They follow the crowd. So we have to be a contrarian and go against the crowd. And like what Warren Buffett said, be greedy when others are fearful and be fearful when others are greedy. What he actually meant was, when everyone is telling you to buy, you should start to think about selling. And when everyone is telling you to sell, you should be thinking about buying. Now, for example, let's look at the S&P 500, the largest index fund in the US. If you had bought the top before the 2008 financial crisis, which was around $158, and when the market crashed, you would have endured a 60 to 70% drawdown, which feels terrible. However, if you are able to ignore the fear and just hold on and keep dollar cost averaging through the ups and downs, you would have bring your average entry price lower, and when the markets recover, you have easily gained back all your losses and be in profit within the next few years. Now, we have to understand that the markets are mostly manipulated by the market makers, the big institutions, the investment banks, and the sharks. They control the media to spread fear and drive the market down so that they can buy more at lower prices. And once they have loaded up at lower prices, they drive the market up with spreading good news to maximize their profit. So if we want to swim with the sharks, we need to think and ride the wave together with them. Now, I've lost so much money and learned so many lessons before I finally start to shift my mindset. So if you can lose, learn, and be persistent to try again, even after being burned, you will have a good chance to succeed in the markets. And again, make sure you learn from your lessons and do not use any leverage or margin. Only invest on what you can afford to lose. So please. Now, how should we invest? Now again, this is not financial advice, and in this video I won't be delving too deeply into investment strategies or techniques, but here are some basics that I usually practice. So firstly, I conduct thorough research and select the investment vehicles that I'm comfortable with to put in my hard-earned money. So for me, it's the stock market, particularly the US stock market, because it boasts the largest capital inflow, often leading to greater price appreciation and volatility. And of course, I opened a brokerage account, and there's so many of it. Just do your research and choose one that you like the most, and I put in the capital that I can afford to lose. So I gradually increase my capital by transferring more funds every couple of months. My rule is to maintain at least 6 to 12 months of living expenses in my bank account and invest the remainder. I then delve into research about potential companies, assessing their business model and future potential growth. I study their balance sheet, analyzing revenue growth, cash flow, debt levels, and other key metrics. Furthermore, I observe social media platforms like X, formerly known as Twitter, Facebook groups, and YouTube as well, to gauge public sentiment surrounding the stocks. Because in today's market, the company's performance alone isn't always sufficient to drive price appreciation. Significant amount of social interest is often crucial. Whether people are enthusiastically discussing or even criticizing a stock, it can be a valuable indicator, especially if the stock price remains relatively low. Now, learning to read the chart is also extremely important and is one of my favorite aspects of investing. I studied candlestick patterns, support and resistance levels, and various other indicators to refine my entry and exit timing. While it's not a crystal ball, this technical analysis provides valuable context and help me make more informed decisions. Combining fundamental analysis, aka studying the company's business and financial, with technical analysis, aka studying the chart patterns, significantly enhance the probability of success. And once I'm confident enough to invest, I always adhere to the principle of buying low and selling high. I remind myself to never buy when the prices are going up, always wait for it to retrace or dip. I usually maintain a long-term perspective, typically holding an investment for at least 3 to 5 years, if not more. Now, if the stock that I purchased experienced a decline and there's nothing wrong with the company, it's basically just market cycles, I will look for opportunities to average down my costs by buying more shares. I remain calm because I've conducted thorough research and have the conviction to hold this investment for the long term, as long as there's no significant fundamental issues arise for that particular company. Now, for example, I am a long-term believer in Bitcoin. I know it's not a company, but I've invested significant amount of time in research and genuinely believe its potential for growth. Now, this conviction allows me to weather the market fluctuation, hodling onto my Bitcoin investment through the ups and downs. In fact, I even increased my holdings during the bear market. So I rambled long enough, and before I end this video, here's a little summary. While no one can predict the market's future, one thing is clear. Time in the market beats timing the market every time. And by investing a fixed amount regularly through dollar cost averaging, you can stay consistent and ride out the volatility. Now, good assets tend to appreciate over time. So if you have done your homework and made informed choices, patience will be your strongest ally. And remember, if you have bought great assets and investments, you don't lose until you click the sell button. So that's a brief introduction to investing. I hope you found it valuable. Now, investing is a vast subject, so please like and subscribe to my channel for more insights into my investment experience in future videos. Do share your current stages in your investment journey in the comments below. And until next time, let's continue making a difference in life. Cheers.